Hey everyone, thank you for joining for another episode of the Dealmaker Series where I'm interviewing some of the top deal makers in DFW. Today I'm joined by Jack Sadden. He is the co-founder of Valesco Industries. Jack, thank you so much for joining us. Give us a little bit of introduction on yourself and Valesco.
Sure. Valesco Industries first. Valesco is a Dallas-based private equity company. We focus on niche manufacturing, high value-added distribution, and what we call product-centric service businesses. Typically, it's B2B business models, but we also occasionally find ourselves in B2C opportunities as well. We provide investment in the entire junior capital part of the capital stack, meaning subdebt and equity. We generally do those in tandem with each other, but occasionally we'll invest in just subdebt or just equity. We're happy to take minority positions as well as control positions. And we typically will commit capital up to around mid fees to low fees on an initial round of capital commitment. We've been around for 30 years. We've consistently invested in the kinds of businesses I just mentioned. We generally describe them as small businesses, meaning enterprise values of 25 to 75 million, although we can do larger and we've also done smaller. That range I just mentioned is typical for us. I've been in Dallas for more years than I can now count. Grew up in Pennsylvania, married my high school sweetheart, have a daughter, no dogs, no cats, no birds, no fish. My friends made me quit golf, so I now am a fitness enthusiast. And if you come by my house on weekends, I like to work in the kitchen, so I'll cook you a good dinner.
All right, well, I might have to take you up on that one for
Yeah.
sure. Well, if you're ready, we can get right to it then. So let's start a little high level. How would you describe the current state of deal making here in DFW or in Texas?
Yeah, James, so I don't sound like the spoiled sport at the party. I want to give a little context because some of my later comments might sound a little bit concerned or a little bit down about the market. We're not, but there certainly are some things that are going on right now that could give the impression of that. So maybe a little bit of background. If you look at in context, my comments are going to be mainly around what we'll call the NA market for the lower small business or middle market. And let's define that broadly as businesses from 5 million to a billion. So middle market's probably the most underdefined term in our lexicon. But for us, we think of ourselves as working with small businesses and lower middle market, which I already mentioned. Think of companies between 15 and say $150 million and the M&A activity around them. If you go back to 2015, over the last decade, it has been a golden era. We have seen steady rises in both the number of transactions as well as the dollars committed, the amount of capital committed to funding those transactions from a number of fronts has continued to grow. The private equity community has really blossomed. We've had the emergence of independent sponsors, and things were rolling steadily along until COVID in 2020. And we had our first really significant dip in a decade. Subsequent to that, you get 21 that went crazy. We had almost a 2x pop going from, let's call it 600 billion in middle market transactions to over a trillion two. And we've trended down in 22 and 23 to the point where the conversation often says, well, things are really slow. Well, last year there was 700 billion in middle market transactions to the PE community. That's still better than the best year pre-COVID. So with that context in mind, yes, we're down, but it's still a pretty robust community in the bigger range of, say, a 10-year look back.
Yeah,
So
yeah.
now more to the point of today. As I mentioned, we've seen a bit of a downward trend in 21, 22 to 23. 25 Q1 has not quite lived up to the expectations. In fact, we're showing a flat to down trend since 2024. And the factors that are straining the market right now probably cover four broad categories: debt financing availability and pricing, availability and quality of investment opportunities, and I'll talk more about that later. The current, let's call it administration out of DC, their strategies and programs have created a fair amount of uncertainty with the economy in general, as well as interest rates. The tariff environment is something that's yet to be seen as its impact. And then lastly, there's excess capital in the markets that you and I would call dry powder on top of a very competitive realm. So all these things are adding together to make for, I think, a very challenging period.
Yeah, that actually swings it into my next question too, is how is the current climate with interest rates and the tariffs now being unveiled, how is that impacting deal flow or the
Yes.
deals?
So the most used word on the airwaves right now and out in the market is uncertainty. Let's put politics aside, but the depth, the breadth, and the speed of changes that are being championed out of DC at the moment has really created a lot of uncertainty. I'm not declaring it good or bad. It just is uncertain. And uncertainty of this magnitude, I think, is a cause for pause. If you couple what's going on with the popular belief among economists, the proposed tariff actions will bring about material inflation and the ingredients for a lot of inaction, conservative behavior in the markets, cutbacks, potentially workforce reductions. All these things add up to stagflation. And when you roll that over to what is all that going to mean, this is the worst case decision scenario for the Fed. Are we fighting inflation or are we stimulating the economy? And that remains to be seen. The good news is for us, we've always found that volatile and chaotic times usually create great opportunities. So if you can just be patient a little bit and let things unfold and stay to your game plan, we think that we're going to get some good rewards out of it as we look down the road a little bit.
I can appreciate that positivity for sure, and the opportunities that can come about through some of this volatility. So you kind of touched on this earlier on. What sort of capital stacks are you seeing now? I think you mentioned the availability of certain kinds of debt, but I'm curious what you're seeing or what you would like to see, as far as capital stacks and how things are getting financed. Talk to us a little bit about that.
Sure. So let's start with a bit of a reminder. We're talking about small and lower middle market private equity investments, or M&A. So the environment right now on the senior credit side, I would describe as conservative to, in some cases, very conservative. What this translates to is lower advance rates or less money in the capital stack coming from banks, stricter covenant requirements when you do get a loan, and I'm going to call it potentially higher rates. You may not have competition between banks, but you may find that the transactions that you're looking to get financed require you to move beyond a bank to a non-bank lender. When you move to the non-bank lender, you're going to see all the things I just mentioned, even more strict and with a slightly higher interest rate. The second part of that is the high rates cause people to be more fluid up and down the capital stack, meaning there is an ask for more junior capital in the capital stack. By junior capital, I mean mezzanine or subordinated debt and more equity. All that adds up to a more conservative capital structure, one that's more expensive. And on the reciprocal side of that, or the corollary side of that, is for those that are providing the junior capital, by having to put more money in and be more restrictive with it, it puts pressure on your returns. Unless you have a very robust performance by the company, it's just going to be harder to make you money.
Yep. And that yet again, kudos to you, kind of swings to the next question. And I think you'd mentioned this at the beginning, or we were talking offline about where are you finding value now?
Yeah, so the question might suggest, have we shifted our strategy on investments in view of some of the conditions we've been talking about? We've been committed to the same strategy throughout our 30 years of investing. As I mentioned before, it's niche manufacturing, very high value added distribution, product centric service businesses. These are business models that many people would say are kind of mundane, but they've been very rewarding to us. They're typically private or entrepreneur owned businesses that are now at a juncture of ownership succession or rapid growth and change. And so they need a partner to join them in order to take that next step. We haven't moved away from that strategy. We've remained committed to it. But what has changed is, where do those opportunities come from, and how do we find properly valued businesses that meet our investment criteria? And so instead of shifting our strategy, what we've done is shifted the emphasis on where opportunities come from. For example, when we were getting started, we would go directly to the businesses that we felt fit our criteria, and we'd send letters, make phone calls, pay visits to them, what we call in our shop direct origination. And that was done through in-house programs. As time went on and as things have changed, even over the last 10 years, we've gone from where 90% of our investment opportunities used to come from this direct origination to now only about maybe 10% come from that direct origination. And we've even changed the way we do that. So rather than all in-house, we have third-party advisory firms that work with us on the buy side. We do a lot in social media to create awareness. And we rely much more on our LPs. We have a stable of independent sponsors that regularly work with us and bring us opportunities to consider. And lastly, we work with a stable of select investment banks and business brokers. All those latter channels have been giving us greater and greater emphasis in our deal flow mix.
I see. And so it's really boiled down to the ecosystem that you've essentially generated in the last few years is where you're
Exactly.
pretty finding that deal flow in the origination.
Yeah.
Okay. I like it. Okay. So last question, and this is the time for the crystal ball, right? So what we're pretty late in the year now, or not late in the year, I guess, but we're out of Q1. What is your outlook for the year?
Yeah, so the trick word in there is forecasting. And if I was really good at forecasting, I probably would be even more successful than we are. But what are we seeing for the year? For the moment, as I mentioned earlier, we remain optimistic, although there are certainly some things that cause us to reflect and talk about how we adapt and improvise and overcome. We think that in volatile, turbulent times, if you stay to your game and work hard at it, you're going to find really good opportunities. But on a broader sense, what do we expect from all those channels of investment opportunity I just mentioned? There was a lot of excitement and anticipation for 25 to be a robust year. Q1 is suggesting that might be a hard goal to accomplish in the market. For the moment, I think that we're certainly going to be as active as last year was, which numerically means I think we'll see as many opportunities as we typically do. And we look at some 1,100 companies a year. The opportunity for things that fit with us may be a little bit challenging than what we've seen in past years. And we may have to do some things to convert opportunities into investments. But I think at the final analysis, we expect to perform at least as good as last year. And I think we can manage to add a couple of new investments above last year's pace, where we invested in 3 platforms last year. And I'm hoping that we'll see four plus. So I'm optimistic, I think, for this year.
Yeah, yeah, it sounds like it. And I like that. I've actually had that same sentiment from a lot of folks that I've interviewed here out of the DFW area, which I love. And part of the reason why I do this is to showcase DFW, its resilience, and the opportunities here. But that about wraps it up, Jack. I appreciate your insights. I appreciate you taking time to chat with me about these items. And for those that are watching, I'm glad that you tuned in. Hopefully you find this useful. You can find more interviews like this and more insights on my website, jamessaki.marketing. And you can catch this interview and several others on my YouTube channel. Thank you for tuning in.
Thank you, James.